This is Stephen Story with Tips on Trading. I want to talk with you about irony in the marketplace for Forex trading. And I'm going to associate this with a personal experience that I had. Actually, not just I, but a large segment of the market who do carry trading. If you're not familiar with carry trading, it's essentially a way to trade in 2 buy positions or 3 buy positions in different currency pairs, but which pairs run in an opposite negative correlation to each other. One is moving in a positive direction, the other one moving in a negative direction. They balance each other out in a natural hedge. Well, there's another little scenario called the carry trade liquidation. You may have heard about it. Sometimes it comes up in the news once in a while when all of a sudden those same currency pairs, instead of running in a negative correlation, change their nature and they run all together and they do a sell-off for hundreds and hundreds of pips in the same direction, which is exactly what carry traders do not want to happen. Okay, they're counting on that negative correlation so they can just leave their money in the market all the time, let it ride through all the swings of the market, just earning them interest every single day. Well, that's a wonderful way to trade if you understand how to avoid the carry trade liquidation, because that liquidation scenario will take your account and you'll lose all the interest you ever made anyway. It will run you to a margin call and you won't even see it coming until it's too late. Or you'll be getting close to it, sweating out, trying to figure out how am I going to swing through this one. I've never been drawn down so far on my account. Gee, am I going to add more money to my account? Oh, am I going to hedge my account? Am I going to change my strategy? What am I going to do? You're going to sweat that one out all the way to the end if you don't know how to avoid those types of drawdowns. I can teach you how to avoid them in an optimized carry trade plan that I work with all my students. We teach them to avoid the drawdowns. We also teach them how to do cash grabs. But most importantly, this little segment today, I wanted you to identify something with me. There was a certain day, I think March 5th, if I'm not mistaken, I might have it off a day or two, but March 5th, if it was a Sunday, that close, in 2007, it was called a Black Sabbath. Black Sabbath dark day for the traders in the carry trade industry that day, because anybody who was over leveraged more than 5% in their account, boom. Carry trade liquidation hit them and they were looking at margin calls, okay? Dark Black Sabbath Sunday. It was serious. But at the same time, the irony in the marketplace was the same time they were experiencing margin calls was the best opportunity for jumping into a buy position, because the market was at its bottom. It bottomed out and turned right around and went 400 or 500 pips in the opposite direction in a short time. If you know how to recognize when a market bottoms out, when everybody else out there is margining, when they're experiencing heart failure, if you know how to identify that moment, that's when you want to get into the market in the opposite direction they were in, because the market is at its bottom. It's at a low and you're prime for a buy position or sell, whichever the case may be. That's Tips on Trading with Stephen Story.